Welcome to ForexTV.com. It's Monday, February 25th. I'm Remy Hookie for your New York Forex Market Buzz. In afternoon trade as of 1:15 p.m. Eastern Time, Euro-dollar is at 1.4825. Sterling dollar is trading at 1.9683, while dollar-yen is at the 108 level. U.S. equities are in positive territory, seeing choppy trading on the day. Earlier, the National Association of Realtors reported that existing home sales fell by 0.4% to a seasonally adjusted annual rate of 4.89 million. And the figure fell less than forecast, but is the lowest since records dating back to 1999. Today I'm joined by Meg Browne, Senior Currency Strategist at Browne Brothers Harriman. Good afternoon, Meg.
Good afternoon.
Thanks for joining us today.
Thank you.
As we start off the week, we have sizable economic data here in the U.S. as well as key Fed speakers, including Bernanke. But investors still remain concerned about a recession in the U.S. while awaiting news on the monoline bond insurer. But we saw the U.S. dollar buying on the heels of this morning's data. So, Meg, if you could highlight the major event risks for the FX market this week.
Well, first of all, the market is still focusing on a recession and also on the outcome of the monolines and whether AMBEC will. There will be a solution that gave a slight that improved sentiment a little bit today, but the dollar has not been able to sustain gains today and is under a little pressure. Stepping back, I should start with the euro and say that in the big picture, we believe the euro is carving out a top, and that it over the course of the year is going to begin a downtrend. That's likely to start in Q2, and it's dependent really on the fact that the Fed and the U.S. government have already provided stimulus, whereas in the Eurozone, the central bank has moved to neutral but not to a rate cutting cycle. So it's lagging the U.S. by at least 9 months, and we think that that's going to begin to bear fruit over the coming quarter. Stepping back to just this week, the euro has been trading in this range 143, 149 over the last 4 months, and we're now at the upper end of that range. There is a risk it breaks higher. We are betting against it and cautioning that the risk reward of a break higher is the rewards are limited compared to the risks. That said, if we're wrong, we could see a sharp move higher, I would say to 151-ish. The reason is that the market has scaled back its long euro positions, and we would expect people to jump in. Now, what's going to affect the euro? The U.S. dollar's withstood a lot of negative information. This week, we're likely to see a fall in durable goods, a volatile number, but a number that suggests that the consumers may be holding off on durables purchases because they're worried about the U.S. economy. We're likely to see another poor manufacturer's report, and so just the general news stream won't be brilliantly uplifting. Bernanke and other Fed officials are likely to repeat what they've been saying all along, which will keep the market expecting further rate cuts, another 50 basis points in March, and with another cut after that. But we think that the dollar's weathered this before, and it's likely to this week. So you might get a sharp move to 151, but then you could easily see the euro coming right back down.
Well, Meg, since you highlighted event risk here in the U.S. as well as covering your expectations for euro-dollar, let's move on to the UK currency. Sterling has remained firm against the dollar, but the long-term outlook has not changed. So given the fundamentals, what is your forecast on a weekly basis for sterling dollar?
Right. Well, sterling last week, it certainly the market has backed away from the degree of cuts it had priced in beforehand, and there are a couple of reasons for that. One is the central bank itself warning about upside risk to inflation versus growth. That has been a little bit mixed. We don't expect that the data is going to improve markedly. We think that the Bank of England is still going to have to cut rates again, and like the Bank of Canada, both central banks are still in the process of cutting rates. That in the long run means to us that the that sterling is likely to come lower. This week, there is a risk that sterling goes another big figure higher. Now, why would it do that? Market's still powering back expectations about the Bank of England, but we would use that opportunity, that rally, to sell into.
Okay, and last but not least, let's take a look at dollar yen and the yen crosses, including euro yen as well as Aussie yen. Meg, briefly, if you could give us your take on the key drivers for dollar yen as well as the yen crosses.
Okay. Well, the yen has reacted more to what's going on in terms of flows and to risk concerns than to what's going on in the domestic economy in Japan. The fact that Japan has very low rates hasn't always meant that the yen has not weakened. At this point, it's still being driven by risk aversion, but also this week it appears that investors in Japan have put money into some new funds, and that money may be going overseas. Now, once we get to this 108.3050 level, we're likely to encounter some resistance, both from Japanese companies and from sovereigns, and that's likely to slow down that break out of dollar yen's range. But the driving forces are going to really flows and risk aversion.
Okay, Meg, as always, thank you very much for your insight and analysis, and have a great week.
You too. Thank you.
Thank you. This has been your Forex Market Buzz with Meg Browne, Senior Currency Strategist at Browne Brothers Harriman. I'm Remy Hokie. Join us later this afternoon for PM Exchange right here on ForexTV.com.